Most of what you hear about central bank digital currencies is either campaign talking points or crypto marketing. Very little of it comes from actually reading what the Federal Reserve wrote, what Jerome Powell said under oath, or what the law currently allows. In this episode, I want to do 3 simple things. First, show you what Donald Trump has actually done and said about a digital dollar. Second, line that up against what the Federal Reserve has really put on paper. Third, walk you through one real digital dollar risk for 2026 and a practical way to reduce that risk in about 1 minute. No drama, no hype, just signals instead of noise. Before we get into it, a quick word on who you are listening to. I have been working around markets, policy, and regulation for about 12 years. I am not a marketer. I do not get paid to pump coins. I am not trying to scare you into clicking on thumbnails. My starting point is simple. If something is not in the law, an official document, or on a balance sheet, I treat it as opinion, including my own. By the way, this is not a financial advice. So as we go, I will be clear about when I am quoting the Federal Reserve, when I am quoting Trump, and when I am giving you my interpretation of what it means. Let us start with Trump because that is where a lot of the current narrative begins. On the campaign trail, he promised that, as president, he would never allow the creation of a United States central bank digital currency and described the digital dollar as a threat to individual freedom and financial privacy. Back in office, he then signed an order that blocks the Federal Reserve from developing or issuing a United States central bank digital currency that could compete with existing cryptocurrencies. On top of that, Congress has been moving legislation that would explicitly prohibit the Federal Reserve from issuing a central bank digital currency, while at the same time building a formal legal framework for dollar-pegged stablecoins. So the political headline is straightforward. Trump is publicly against a central bank digital currency, and he has acted to stop a United States digital dollar at the central bank level while opening more space for private digital dollars to grow. Where the online story often goes further than the facts is when people jump from that to claims like, the Federal Reserve had a live retail central bank digital currency ready to deploy, and one executive order personally saved every bank account from an instant control system. That is not what the documents show. To see what is really on the table, you have to look at what the Federal Reserve has actually published. In the year 2022, the Fed released a discussion paper called Money and Payments, the United States Dollar in the Age of Digital Transformation. In that paper, a United States central bank digital currency is defined as a digital liability of the Federal Reserve that is widely available to the general public. In plain language, today, paper cash is a physical liability of the Fed. A central bank digital currency would be a digital version of that, issued by the central bank, usable by households and businesses, and different from bank deposits, which are liabilities of commercial banks. 2 points in that paper matter for this conversation. First, the Fed labels it as a discussion document. It is framed as the start of a public consultation, not as a decision to launch anything. Second, the Fed states that it would not move ahead with a central bank digital currency without clear support from both Congress and the executive branch. So at that stage, you have a definition and a set of questions, not a rollout plan. Since then, journalists and lawmakers have kept asking Jerome Powell whether a central bank digital currency is actually coming. His public line has been consistent. He has said that people do not need to worry about a central bank digital currency because nothing like that is remotely close to happening. And he has gone further to say that the United States will not have a central bank digital currency while he is leading the Federal Reserve. Put that together. A discussion paper, not a launch statement, no official announcement of a retail central bank digital currency project, and a Fed chair who is on record saying it is not remotely close and not happening under his watch. That does not look like a secret retail central bank digital currency waiting in a drawer for the year 2026. Now let us look at the part that gets turned into a control story. Online, you often hear the strongest possible version of the fear, which sounds something like this. With a central bank digital currency, the state could approve or decline every transaction. It could program money to expire, and it could turn off specific people's balances for political reasons. Those are all design choices that are technically possible in some form if a system is built that way. They are not today written down as the official design of a United States retail central bank digital currency because there is no authorized United States retail central bank digital currency on the table. In the Federal Reserve's own material and in serious legal analysis around it, the repeated themes are different. Any central bank digital currency would need some degree of privacy protection. It would almost certainly be intermediated, meaning banks and payment providers would still sit between individuals and the Fed. It would sit inside existing Know Your Customer, anti-money laundering, and sanctions rules. And it would require explicit backing from Congress and the White House before it could move beyond the research stage. So, when someone claims that an all-powerful retail control grid is built, approved, and only prevented by one politician, that is not backed by the Fed's own words. The real picture is more boring and more constrained. There is another important point that almost never makes it into viral threads. Even without a central bank digital currency, most of your money is already digital. For most people, most of the time, dollars live as balances in bank accounts, card balances, and balances inside payment apps and brokerages. Those sit on top of private and regulated payment rails. Banks are already subject to the Bank Secrecy Act, to anti-money laundering rules, and to sanctions regimes. Card networks already have merchant codes and block lists. Payment platforms already freeze accounts when a compliance system flags something as suspicious. So if your core concern is that a small number of institutions can block or slow down certain payments, that is a feature of the current system as it actually exists today, long before any central bank digital currency is launched. That does not mean a central bank digital currency would be harmless or irrelevant. It does mean that the baseline is not a perfect world of anonymous, uncensorable money suddenly ruined by one new instrument. So, what has actually changed under Trump so far? On the public side, he has moved to stop the Federal Reserve from building or issuing a central bank digital currency. That closes off the path to a Fed-issued retail digital dollar for as long as those rules and that political environment remain in place. On the private side, the administration has been moving in the opposite direction. It has backed a legal framework for dollar-denominated stablecoins, bringing them into a clearer regulatory perimeter and encouraging them to scale. It has also been talking about making the United States a global center for crypto activity and about building up a strategic reserve of digital assets. In practice, that means fewer steps toward a public central bank digital currency and more steps toward a larger universe of privately issued digital dollars. So the choice is not between a world with digital dollars and a world without them. The choice is between different architectures for digital dollars, with different trade-offs in terms of who controls the rails, who carries the risk, and where the political pressure points sit. That brings us to the real digital dollar risk for the year 2026. If more value migrates into stablecoins and tokenized cash while the public central bank route stays frozen, more and more dollar exposure sits on platforms that combine technology risk, business risk, and regulatory risk. The danger for an ordinary investor or saver is less likely to be a surprise launch of a Fed wallet and more likely to be things like a run on a major stablecoin issuer, a platform losing its banking access, or a rapid change in how regulators treat specific tokens, custodians, or jurisdictions. You cannot control those decisions, but you can control how exposed you are to any single point of failure. Here is a simple, practical way to cut that risk down. First, spread your liquid dollar exposure. Do not leave everything in a single bank, a single stablecoin, or a single app. Use at least 2 banking relationships and think carefully about how much you really need to leave on any one exchange or wallet. Second, always know who your counterparty is. Every dollar you see on a screen is a promise from someone. That someone might be a bank, a broker, a stablecoin issuer, or a fintech platform. If you cannot answer the question, who owes me this money, that is a red flag. Third, keep a boring, low drama layer. Hold part of your safety net in things that are dull on purpose, like short-term government paper, conservative money market funds, or well-insured bank deposits. That layer is there so that you do not have to care about every headline. Fourth, secure your access properly. Most real-world losses come from bad security, not new monetary architecture. Use a password manager, turn on strong 2-factor authentication, and do not recycle exchange passwords across your digital life. None of that requires a central bank digital currency. None of that depends on who is in office in any given year. It is just basic hygiene for a world where digital dollars are already the norm. Finally, a quick look at the bigger picture. While the United States is blocking a central bank digital currency at the Federal Reserve level and growing private digital dollars, Europe is pushing ahead with work on a digital euro and on stablecoin rules because it is concerned about losing monetary influence. China is continuing with pilots of its own digital currency inside its system. So the real geopolitical contest is not just who launches a central bank digital currency first. It is about which digital infrastructures become the default for trade, savings, and payments across borders, and who sets the standards those infrastructures have to follow. If you have watched this far, you are probably not here for panic thumbnails. You are here because you care about how policy, technology, and money actually interact, and because you would rather see the primary sources than the marketing. If you want more work like this, where we walk through what the documents say and what that means for investors, savers, and citizens, you can subscribe and keep this channel in your toolkit. No pressure, no countdown, no urgency tricks. And if you want to help shape the next episode, leave a comment with the most extreme central bank digital currency claim you have seen recently. In a future video, I will take a few of them, trace them back to their origin, and separate what is technically possible, what is legally realistic, and what is just storytelling. That way, you are not relying on slogans from either side, and you can navigate whatever happens to the dollar in 2026 with a clearer map.